The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. We often see many asking when to start or how to start saving for retirement, how to grow our retirement savings while keeping them secure. Meanwhile, across the globe, Australia's superannuation system has long been praised for striking that balance, helping millions of Australians plan for a comfortable retirement through disciplined investing and smart risk management. So what lessons can Singapore's private wealth and fund managers draw from Australia's approach? How can investment vehicles be designed to bridge the gap between security and growth for private clients? And what practical steps can Singaporeans take today to make their retirement nest egg work harder? Well, to find out more, joining me now is Steve Alain Lawrence, who's the CIO of Balfour Capital Group. Steve, welcome back to the show.
Well, I'm great being on, and this is going to be a really interesting conversation.
All right, let's kick it off by asking you, well, Steve, could you briefly explain what Australia's superannuation system is and why it's often held up as a model for retirement investing?
Well, what you need to understand with the superannuation fund, it's based on the U.S. system of a 401k. What does that mean for the listener? It's mandatory that the company puts in money, mandatory, but the investor, meaning the individual, has a choice. And that being said, it gives them a lot more upside in what they can invest in for their future. Whereas, let's say, for example, the Central Provident Fund, the CPF, it's a very low risk item, which guarantees about 2.5% on your money. So there's a big difference.
Okay. Well, then, in your view, what are the core principles that have made Australia's system successful over the decades?
Long-term investing. No question about it. In it for the long term. All right. When you're investing in the market, you've got to look at the long term and the diversification of what you're doing. And I think that is the most important aspect of any investment strategy. It gives a balance between growth and security.
Well, one of the strengths often cited is how superannuation balances long-term growth with capital security. So how is that balance achieved in practice?
In practice, from a real practical point of view, when someone invests, when Mr. Jones invests in the market, the first thing he needs to understand is the risk associated with it. And by working with superannuation funds, they'll negotiate fees all for the long term because it's a long-term investment. It's not meant to be a short-term investment. And that is the juxtapose of what the entire process is. And when you look at, like, for example, the CPF, a super ultra-conservative investment. But what the public is seeing is they want to be able to take some of the retirement funds and have their cake and eat it too. But in general, Singapore is a very, very conservative country by design. You have to agree with me there.
Definitely. I mean, I want to talk about Singapore and just make that comparison here. Do you think Singapore's CPF system currently strikes that balance, or is it tilted more towards security than growth?
Totally towards security. Okay. Totally towards security in the sense that, you're guaranteed about 2.5% on your money. But the public wants to be able to invest their money in other products. And there are self-directed super funds, meaning that the investor has the ability to direct an investment towards anything on his own. And I think that's one of the things that you're going to really see, okay? You see, with the CPF, it's mandatory. Everyone has to contribute. With the superannuation, okay, what you need to understand, it's mandatory for the employer contributions, but employees can add voluntarily. There's a big difference. And the U.S. system, other than Social Security, many workers don't even participate or even save enough. So all the systems are very, very correlated. It's all about how they can get into the stock market and then go to bed at night. And I think that is the most important part of what it's all about.
Well, then what can private wealth and fund managers here in Singapore learn from how super funds are structured and managed?
Well, what you need to understand, the only thing they need to understand is money managers is finding the best potential long-term investment for their customer. And Singapore runs a very conservative model, but at the same time, the public wants to take some risk with their own retirement funds. And how do you determine what that risk is? How do you quantify that risk? And that is the main issue, quantifying risk. It's never how much you make, it's always how much you potentially lose. But when you're in it for the long term, 20, 30 years, it's a different type of investment strategy. It's not like I get in on Monday and I get out a month later or 2 months later.
Right.
Just imagine if the investor in Singapore owned, for example, Meta 10 years ago, or Texas Instrument. I can go on and on and on. And I think that is the only thing that matters.
Okay. I mean, Australia has some of the world's largest institutional investors through super funds. How has scale then helped in assessing global opportunities? And can Singapore's fund managers replicate this in their own way?
Of course they can, but you need to, let me just make this very clear. They've only got $3 trillion under management, okay, the entire country. I mean, you're talking about a small geographical area which is taking, the model of the heavy hand of the United States of America to understand it. $3 trillion, the market cap of the entire ASX is relatively small. That's why it's about global diversification, global. You see, the investor wants to be global, and today you have to be global. It's not if the market's telling you that.
I mean, many Singaporeans with higher wealth, they look beyond CPF for better returns. So, Steve, what kinds of investment vehicles do you think can help bridge the gap between CPF's conservative approach and private clients' search for yield?
Well, there's two things. The first thing is that there'll be, within the CPF, there's going to be a self-directed component to it that they're going to create. With the investor, will have the ability to self-direct his own funds. And that has been the key component of the IRA, of also the self-directed superannuation fund, that the customer, the client, the person who's actually making the money can actually make a business decision and direct his own retirement funds in a certain way.
Are there any lessons from how super funds use alternatives, infrastructure or private equity that Singapore's managers could adapt for individual investors?
There's no question about that. They're already adapting it, okay? Because what you have to understand about Singapore is that from a conservative base, it's there. If you invested in the CPF at 2.5% and never touched your money, okay, if it compounded over, X amount of years, you'd still make money, but go to bed every night because they're guaranteeing something. But the reality is, with today's technology, and the world is so connected, the public wants to feel that they're in control of their own money. And the only way they can do that is by literally allocating money to investments that they want to do on their own. But here's the but part, buyer beware. You have to know what you buy. And that's why it's diversification.
Well, given today's macro environment, higher inflation, volatile rates, and global uncertainties here, Steve, what asset classes look most promising for retirement-focused investors here?
I'll give you two answers on that. If you're in it for the next 20 to 30 years, just investing in the indices in themselves as they get balanced. What you need to understand that if you look at the model of Vanguard, of all the bigger model, it's about how you invest in the indices. Now, if you're a much bigger risk taker and you want to make X amount of dollars and you want to go into an alternative investment, there's a probability that you could lose all your capital. I mean, that's just the bottom line. I mean, nobody thought that Sears Roebuck would go out of business. We can go on and on with that.
Right.
Nobody thought Evergrande would go out of business. Evergrande. I mean, so the moral to the story is this: by investing in the indices for the long term, you're much better off.
Well, then, do you think Singapore needs a more formalized superannuation-like pillar to complement CPF, or should it be left to private markets to innovate?
I would say it like this. The CPF, it's got a very heavy hand with very tight controls. In order for the CPF to really extend themselves for the public, they're going to have to loosen up some of the regulations with it. And they will, because they're seeing it, because the public actually wants that.
Well, then what would you say is the single biggest lesson from Australia's super system that Singapore cannot afford to ignore?
Well, it's very simple. The self-directed superannuation fund has been a game changer for the investor, that they have the ability to make their own business decisions, because at the end of the day, whose money is it? It's their money. It's the consumer's money. So he should have the freedom to decide what he should buy or not buy.
Okay, and finally, if you were advising a Singaporean in their 30s or 40s today, Steve, what's one actionable step they should take now to secure their retirement?
A very direct answer. Invest in various indices. Invest in the S&P 500. Invest in the Hang Seng. Invest in the CAC cutoff. Invest in the DAX. And just by having that exposure with the indices, you're going to be able to ride out the storm long term. Now, if you want to take more risk as an investor, you want to make an investment on a Bitcoin or something that's alternative or a new startup, a venture, that's on you as the investor. But as the investor, you need to have control. Without control, you have nothing.
Definitely some great tips from you there. Thank you so much, Steve, for your time and your insights today.
Well, thank you for having me, and I hope I helped out the listeners, and always great being here.
Thank you so much.
A pleasure speaking with you. You too.
A pleasure as well. That was Steve Alain Lawrence, CIO of Balfour Capital Group. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.